The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
Hi, so I got to speak with SEC Chair Gary Gensler about crypto, and I think number one question is really, how is he looking at crypto regulation? How is the agency approaching it?
So, Nick, good to be with you. Good to be with an audience of CoinDesk subscribers or viewers. I think about investing in the context of markets, and we at the Securities and Exchange Commission were set up nearly 90 years ago, and it was to protect the investing public. And the speech that you reference, I start with that. I start with those foundational things around President Roosevelt, Congress, what they tried to put together, and the first chair of the Securities and Exchange Commission, Chair Kennedy, who was President Kennedy and Senators Kennedy's father. And so I think of it in that context. And 90 years later, those basic bargains are really what it's about. When somebody is raising money from the public gets to decide which risks they take. We at the Securities and Exchange Commission are not a merit regulator. If you want to take a risk, take a risk. But we are, and what our regime is about disclosure, making sure there's full and fair and truthful disclosure. Even President Roosevelt called it the Truth and Securities Act, the first of our 4 key acts. And so I think of it all in that context. Satoshi Nakamoto writes the white paper, Halloween night in 2008. A number of years later, people start to invest in it. They're buying and selling it. Some years later, we start to see other coins, other tokens. And, if you just look at coinmarketcap.com, there's 10,000 or so tokens listed there. Some have more liquidity than others, of course, and some have more value than others. But what is the investing public doing? They're investing for a better future based upon the efforts of others. There's websites you go to. There's Medium posts that you read. There's crypto Twitter. There's Reddit forums and places you can look for information. And it's about that common enterprise and that entrepreneurial effort, which is the hallmark of investment contracts, which are securities. So I think that's where we are, is that that most of the tokens meet the traditional standards that our Supreme Court has laid out, and that we, the SEC, have a role to help protect investors and instill and enhance trust in these markets. But back to you, Nick.
Well, so to your point about instilling trust in these markets, you've said on numerous occasions that you believe a lot of crypto trading platforms, which we commonly refer to as crypto exchanges, should be registered as national securities exchanges because, in your view, and in the view of your predecessor, Jay Clayton, and in the view of, I think many other SEC staffers and even lawyers, a lot of cryptocurrencies do resemble securities. What's the next step?
They don't just resemble, they are securities, Nick. They are. I mean, Thurgood Marshall, a great Supreme Court justice, wrote in an opinion, and I think it was in the 1970s, that Congress painted with a broad brush to protect the public. And when somebody is raising money from the public and the public anticipates a profit. And so that's kind of the core. And yes, the service providers, if you wish, the crypto exchanges, the crypto lending platforms, whether they call them centralized or decentralized, so-called DeFi, they're transacting and providing services to the public. And they're providing those services around some very small handful of non-security tokens, crypto non-security tokens, but the vast number of these thousands of tokens, without prejudging any one of them, meet the standard of being a security. And thus the platforms have an obligation to come in, register, work with us, find a path forward. But ultimately, it's about protecting the investing public. And if the investing public's investing in crypto, to have some basic protections. Look, we just went through a time earlier this year where a number of platforms went bankrupt, or they just froze out their customers. Now, I wonder about how many of your readers got frozen out or held, and they just get in line in a bankruptcy court. Or even if the platform started to honor their obligations, sometimes they were frozen for 3 hours or 3 days or a week. And there's basic protections in our securities laws that guard against that. And what's more, right now, if you're investing on any one of these service providers' platforms, you're not getting those basic protections, ensuring against fraud, manipulation, what's called front running. Further, the platforms are an amalgam of different services. Not only are they doing what you might be familiar with at the New York Stock Exchange, but they are also doing things that they're acting as a broker against you. They're like an amalgam of dealers trading against their public, maybe trading ahead of you based upon your information as the investing public, that they could be trading ahead of you. And our securities laws say, no, that's not allowed. So there's a lot of protections that you right now are not getting the benefit from, but should be because it's the law.
Right. So, I guess my question is, what's the next step in having these platforms register as securities exchanges, or come in?
The next step is if they successfully register, then the investing crypto public gets to decide. Look, these are, by their very nature, speculative assets. There's, give or take, 10,000 of them. And pretty much any venture capitalist would probably tell you that most startups fail. That's just the nature of the economics of startups. And so the investing public, will get a fuller disclosure about those individual token projects. You'd also have protections in your trading against fraud, manipulation, and that the transparency of those platforms, how orders are matched and the like. And that if they are also dealers, that it get separated out. This amalgam of different features that they're doing gets separated out. If you have a desire to take your crypto and lend it, that you actually have some disclosures that the service provider providing you that interest. And remember, if somebody says reward or yield or interest or return, the label doesn't matter. It's similar to when you put your money with the money market fund and you say, well, they're going to give me a return, but then they actually have to disclose what they're doing with your money. And it's your money ultimately. What are they doing with it? Are they trading like a hedge fund? Are they lending it to somebody else? Are they putting it in safe assets or, more speculative assets?
I guess I should have clarified. If these platforms don't come in voluntarily, though, which it doesn't look like any of them are, is the SEC prepared to bring enforcement actions? Is there a rulemaking process?
Well, Nick, we've been doing that by my predecessors. I think you can go to our websites and read about it. And sometimes the entrepreneurs and service providers in this field will say, "What has the SEC said on this?" The SEC has said a lot. We've, as a commission, as a 5-member commission, have spoken to this numerous times, dozens and dozens of times. Every enforcement action, it's voted on by a 5-member commission, right, by my predecessor commissions, and then I'm honored to chair. We've spoken about it directly in 2017, 5 years ago, in 2 really important circumstances, something called the DAO report, and the Munchie order, both in 2017, that laid out, consistent with Supreme Court cases, when tokens are securities. And so it's actually pretty straightforward there. And we are a cop on the beat. That's what Congress set up in the 1930s. But we work with market participants. And I said this, I'm quoting Joe Kennedy, the first chair of the SEC, who spoke, I think, clearly on this. And he said, no honest business need fear the SEC. Come in, we'll sort through. We will look to see how we can facilitate compliance using those tools in our regulatory toolkit. We have various tools that the community understands about how to try to fit this in. Look, I'm technology neutral. Before I was in this job, I was not so technology neutral, maybe because I was honored to be at Massachusetts Institute of Technology and studying and researching and teaching on the intersection of finance and new technology around artificial intelligence and finance, but also around this topic, crypto markets and finance. In the job I'm in now, I'm technology neutral. I mentioned that to give you a sense of from where I come, but I'm not public policy neutral. And I think that the investing public not only deserves to be respected and to get, just basic disclosure and anti-manipulation, anti-fraud protections, but also other issuers, other companies and entrepreneurs that raise money need to have somewhat of a level playing field here. And I think without that, this field can't reach any of the goals that many of the readers of CoinDesk might believe. If you believe in crypto, and I know there's both people that believe in it and don't believe in it, but if you believe in it and you want to invest in it, I would say this: few things ever persist without coming into basic public policy perimeters, protecting investors, not undermining our capital markets or our financial stability at large. Yes, being inside of the remit of fostering just legal activity and not illicit activity. Those are our basic bargains in our economy.
There's a lot to unpack in all of that. I guess one of the first things I'm really curious about, just based on this last part, is, the SEC, we're seeing enforcement actions being brought against companies that conducted ICOs as far back as 2017, 2018. Is the SEC able to keep up with the sheer number, 10,000 cryptocurrencies out there, or does the agency need more resources to address, what is frankly a flood?
Nick, I thank you for raising that. I joined an agency about 1.25 years ago that had actually shrunk about 5% in the prior 4 or 5 years. And the capital markets, as we all know, had grown quite significantly, not just in value, but in complexity and numbers of public companies, number of investors. And then this crypto field came up. And though it's give or take upon this recording $1 trillion of worldwide asset value, the US capital markets are a little over $100 trillion in total. So we've got a lot going on. I'm really proud of this agency, but we had shrunk about 5%. So absolutely, I think that we should be at least where we were in 2016 and should be above that. We should have grown in this period of time with regard to this. But I would say this to any of the lawyers and accountants and entrepreneurs out there that are advising folks in this field. If you're thinking about doing a project, come in, talk to us, let's get it right. If you've been doing a project for 3-6 years and so forth, and don't wait for us to knock on your door. But I would say this also, Nick, this is a very concentrated ecosystem. Some would say otherwise, but there's really a handful, 5, 8 crypto exchange platforms that have the dominant market share. Similarly, in so-called lending platforms, even though a handful of them just went bankrupt. And so too also in the so-called decentralized finance or DeFi space. These are highly concentrated actors and players. They often have hundreds of tokens on them. So given what we've discussed, it's highly likely they have securities on them. Come in, work with us, work on getting the right facilitation around your exchange function, your broker-dealer function, your custodial or clearinghouse function, your lending. And we've spoken on a clear voice. I mean, over a year ago in a speech, I said, make no mistake, if you have a platform and you're lending or borrowing crypto securities, you've got to come in and work with us and get registered. And we did that with a company named BlockFi earlier this year, and we're still sorting through in the crypto lending space. So there's a path forward here.
Do you think that, and not necessarily the SEC specifically, but some of these lenders that are currently bankrupt, we've heard that, numerous state regulators and the SEC have been looking into quite a few of them. Celsius, for example, just today, the Vermont Department of Financial Regulation said that over 40 states are looking into Celsius operations. But that hasn't stopped, these companies from taking investors' money and then, as you pointed out, they're currently going through bankruptcy proceedings. Is there more that regulators could be doing to be proactive on this issue to, prevent it getting to a point where these companies are built up and they have this huge investor and customer base, and then they, go to the courts and say, hey, so we need some, bankruptcy protections while we try to restructure our operations?
So for your listening public, let me just explain. I can't speak to any one company. I can speak about things in the past, as I did the settlement with one company, as I did about BlockFi or the Dow report from 2017. But so let me just go to a more general question that I think you have. I think the investing public, whether you want to go and buy crypto or even you think that it's all too highly priced and you want to short it. And remember, those risks are your choices, whether you're pro or you want to go short. They're entirely your choices. There's a role for the official sector. The bulk of the tokens, though maybe not the bulk of the market value in crypto, but the bulk of the tokens have entrepreneurs at the middle, have a website, you're reading the Reddit post, you're reading the Medium and crypto Twitter, you're following those, and there's somebody in that middle generally touting that. We're trying to help and look out for you. And on these concentrated actors, the central actors, the exchanges, the lending, the custody, the so-called DeFi. Right now, you're not getting the compliance. The investing public is not only taking a risk on crypto, but you're also taking a risk that the platforms are even doing what they're saying they're doing. And so I think that we're actually aligned with the crypto investing public more than sometimes the news would report, and the like. I do think that in terms of the lending platforms, it's unambiguous, because it doesn't matter what you hand over to a platform. If you hand over gold, if you hand over Bitcoin, or you hand over any one of 1,000+ alternative coins, frankly, if you handed over chinchillas, that the platform is taking those funds of value and doing something with it. They might be operating a hedge fund, they might be lending it out, they might be operating other investment schemes, but that platform is under the securities laws because of how they've taken that money from you, and that you deserve the benefits of disclosure and certain investor protections. And we're going to continue to be leaning into that, but at the same time, trying to work with the platforms, the service providers. I mean, there's probably only 20 or 30 that you really cover at CoinDesk actively. I apologize, maybe you're going to tell me that you cover a lot more lending and exchanges and platforms. But it's pretty concentrated market share there.
Yeah, I mean, I can't speak to with any certainty as to how much we cover. We've grown quite a bit in the last couple of years. I do know we have written about some of the potential dangers posed by these same companies that we're now talking about. But this kind of really just brings me back to my first question, which is what role does or should the SEC have in just being more active with these lenders, with these trading platforms, and all these other service providers that they believe that they don't need to come in to talk to the SEC or register. At what point does it go from an invitation to something more forceful?
So let me close on this, because I know our time is about up. I think that the platforms would be prudent to take the opportunity and work with us. We are a cop on the beat, and that's what Congress wants. That laws and rules are meaningful, but as everybody knows, if there wasn't a cop on the beat, things would get a little messy on the highway. And if I could just do an analogy to football, I mean, what would the game of football look like if we didn't have rules of the play and everything, and there were no refs on the field? Congress writes the ultimate laws, but we are the ones that have to oversee the markets, like the refs on the field, and write some of the on-field rules. That game of football would look really messy after a while. And after a while, it wouldn't even look like rugby. It would be really messy. And the fans wouldn't want to come after a while. And so I just think that you're right. There is a role to work with these companies and service providers, both in the intermediary space and the token space. But there's also, we're going to be a vigorous cop on the beat. We're going to work very closely with our colleagues of the Commodity Futures Trading Commission, because part of this market, what I'll call crypto non-security tokens, I think it's very few tokens, but again, they have a lot of market value. We're going to work with our colleagues at the U.S. Department of Treasury and the Federal Reserve around stable coins and ensuring that there's the appropriate safety and soundness in those markets as well, and our international colleagues. I mean, there's a lot to be done here. If we're successful, there'll be more trust in these markets, and investors will get to decide, and entrepreneurs will decide, and projects will win or lose or fail based on their inherent risks. But right now, we've got another set of risks, and it's the risk of non-compliance with investor protection or non-compliance with broader safety and soundness public policies. And working with our fellow regulators, we're going to continue to use the authorities Congress gave us, but also the mandates to help best protect the public.